Hi guys, welcome to my videos, and for today I'll be talking about adjusting journal entries, specifically in deferred revenue. So let's jump right in. First, we will go through the definitions of adjusting journal entries. So what is adjusting journal entries? Well, adjusting journal entries are entries that made in general journals to record revenues or expenses that has been earned or incurred but not yet recorded. And the process of recording and posting adjusting journal entries is the fourth step in the accounting circles and occurs at the end of each accounting period after the trial balance is prepared. So what are the scenarios that we need to adjust our journal entries? The first is deferred revenues, when cash is received before revenue. Second is accrued revenue, is when cash is received after the revenue. Deferred expenses, which is cash is paid before expenses, and accrued expenses is when cash is paid after expenses. So we will go through scenario 1, which is deferred revenue. So as you know that companies sometimes receive cash before they earn revenue. Let's take this one as an example. Let's just say that Tom is a gardener and was hired to take care of the Smith's garden. On the 1st of January, Tom received the totals of 24,000 for 12 months doing the job. And his job finished at the end of the year, which is the 31st of December. So we will record this transaction is we increase the cash account by the amount received, but now Tom has the obligation to his customer to take care of the garden. Therefore, the entries also increase the liability account, call it unearned revenue, because Tom hasn't providing his services, so he cannot record it as revenue. But suppose that Tom prepared the financial statement at the end of July, and as of 31st of July, Tom has provided 7 months of revenue, which is $14,000. So we will record this is we increase the revenue account by the amount earned during 7 months, and we decrease the liability account and earned revenue by the same account since Tom has finished his part of his obligation. Therefore, liabilities are decreasing and equity is increasing. That's it for today, guys. Thank you for listening.